So hello, it's nice to have all these out-of-town guests coming to my adopted hometown of Denver. And we seem to be the epicenter right now of the regulated legal cannabis industry, having adopted full legalization starting the first of the year. And hopefully you've all been able to get out and do a little shopping here in Denver. We have plenty of fine cannabis shops to choose from. So as Michael introduced me, I do a lot of work in this industry, starting in 2009. Yeah.
Is that working?
No. There it goes. So starting in 2009, and I'm having a hard time seeing my own slides here.
Right here.
Oh, there we go. Thank you. You know, Amendment 20, we've had legal cannabis since the year 2000, but it wasn't until 2009 under the Obama administration that the folks here in Colorado felt comfortable opening retail shops. And without any regulation, probably within 6 months of that memo coming out in the fall of 2009 from the Department of Justice, we had 800 retail shops here in town. And our patient count for medical got as high as 129,000. Interestingly, we still have over 100,000 medical patients on the registry, so just bringing in full adult use cannabis does not seem to diminish the interest in patients having access to cannabis. And part of the reason for that is some of it is economic. The industry, and it speaks to the ethics of the medical marijuana industry, has been keeping the prices lower for the medical patients than it has for the recreational or adult use patient. And they also pay less taxes here in Colorado. Part of our passing of full legalization in the fall of 2012 was that taxes came with it. So they were able to put an additional tax on top of the regular sales tax here in Colorado. In Denver, if you go to the cash register, you'll pay 21.12%. So test them and make sure they're doing it right, and tell them you heard it should be 21.2%. That includes all the taxes. In addition to that, there's a transfer tax at the pound level. When pounds are transferred from the grow to the dispensary, even if it's self-grown, they pay a tax of approximately, they base it a 15% tax based on an estimated wholesale price of $1,800 and change per pound. Oops. Here's a very recent chart of sales tax in Colorado with the medical and the recreational combined there. The next one, and my slides I believe are available through the website, but you can see that in April they collected almost 4.5 million of tax on marijuana just in the month of April. And then this is from the Colorado Department of Revenue. Have done a very detailed study on what they anticipate. They're anticipating retail sales, including medical, to be over $1 billion by 2015, 2016, and be collecting $150 million in sales. But I'm going to skip to this because this is what we're here to talk about today. This is just a little brief background of what's going on here in Colorado. This slide actually comes from the IRS audit manual, which they didn't really share with me, but they did. We went over this in my office. And 280E prevents essentially the deduction of overhead. And the big three, as I call them, that are disallowed are retail rent, retail labor, and advertising. Those are considered selling costs, and are under audit, the IRS will disallow those expenses. Now, Henry Wykowski will talk a little bit about some success he's had in getting allocations. I'm here to tell you that in Colorado, I have not had success on allocations because and saying that you offer other services, so therefore you can allocate some of your overhead, get that deductible in line with the Champ case, which is a very famous case that Henry participated in. What the IRS has said to me point blank is, look, at 99.9% of your client sales came from selling marijuana. we think that he has one line of business, and we're going to follow the Olive case. In the tax courts, there's been two significant cases, the Champ case and the Olive case. Henry was involved in both, so I'm sure he'll speak about those. But the unfortunate upshot of those two cases was that 280E does apply to this industry. So for better or worse, we really need to deal with it. And I think it's perhaps the most important issue facing this industry today. I'm working on 2013 tax returns, and I'm seeing taxes, and there's 280E there. In this particular example, the overall taxes are almost 65%, because that third line down there of gross profit of $667,000, that's what you'll pay tax on. And assuming a 40% tax, if you drop down there to the income tax, $266,000 is the income tax, resulting in 63%. To tell you the truth, this slide is probably the best case scenario you're going to get. I'm looking at situations where people's taxes are anywhere between 75 and 125% of their net income. If you have a lot of retail expenses and those are disallowed, your taxes can actually be more than your net income. And I'm not saying that to alarm you, I'm saying that because I'm seeing that. The IRS looks at this industry as a cash cow. I'm very active politically in this industry, and some of the questions that we were getting from Congress recently kind of disturbed me. They were saying, well, if we repeal 280E or fix it somehow, how much will that cost the federal government? And that was not the question I wanted to hear. So they've already budgeted in cash flows from this industry. Also, being a regulated industry here in Colorado, I think, is a disadvantage for us. Because in California, for instance, a lot of the shops do not have state licensing. They don't have statewide licensing in California. It makes them a little bit harder to identify and choose for audit in the IRS computer system. Here, our license holders for retail and also grows, which are integrated here in this state, all of our license holders are public information. We down that list about every 60 days to see how our clients are doing with their applications. Now, if I can download that, I would think that the IRS has thought of that as well, because it seems like they're going right through the list. I estimate that about 20% of the industry is being audited right now, and the IRS is strictly enforcing 280E. We're a for-profit model, and that puts us at a slight other disadvantage that we can't make the arguments that they do in California, that they're collectives and shouldn't be subject to tax. So we go back. That gap there in the illegal business, the IRS basically wants to see two numbers on the tax return: sales and cost of goods sold. They don't really want to see anything else on a marijuana tax return being deducted. Now, one piece of good news is that they are being very generous to a degree of what they're allowing into cost of goods sold. So we have been able to allocate officers' salaries if they spend time managing the garden. We've been able to get them to include packaging materials and labor for harvesting and trimming and weighing. We've even, in one case, I got the IRS to include interest expense in cost of goods sold because the funds were used to build out the cultivation center. So, but unfortunately, that is the end of my good news. So the industry really needs to fix this thing, because even if it got fixed tomorrow, we still have 3 or 4 years that are open to the statute of limitations that can be audited. So it's a very serious issue. The fixes are, my understanding is that the power to deschedule marijuana rests in the executive branch. So President Obama could deschedule this tomorrow. I'm hoping he does it by the end of his term. I don't see Congress as being in any position to make a fix to this right now. They're very dysfunctional, as we all know. And a tax bill would be huge and complicated, and chances are a 280 fix would be an attachment to a larger tax bill, which there's nothing underway in that area right now. Another way to fix 280E, though, is through the Controlled Substances Act. And while I'm on that subject, 280E was meant to be applied against illegal drug dealers. It was a knee-jerk reaction to a case the IRS lost in the early 1980s to a drug dealer, where the tax court judge allowed the drug dealer to deduct all his expenses, including even business use of home. And that's where 280E came from. So another fix to it, though, could be through the Controlled Substances Act. and make a change there, which wouldn't need a large and complicated tax bill to get through Congress to be able to fix it. Which leaves us with the courts. And there are cases now percolating through the system. You know, I have some 2010, 2011 vintage audits that are now gotten through the appeals process here in Denver. And my appeals meetings met with deaf ears. They like this chart right here, and they're sticking to it. So we got no satisfaction at appeals. They still denied all the overhead for our clients. And so once you go through the appeals process, you have the option of going to tax court or federal district court. And how am I doing for time?
You're good. You're great.
So the benefit of tax court is you don't have to pay your taxes. The disadvantage is, and I have conversations with people who are pretty high up at the IRS here in Colorado, the disadvantage is that the IRS has been, in their mind, winning in tax court. So tax court is a fairly unfavorable venue for this industry in that it's unlikely that a single judge would want to stick his neck out and be known as the judge who did away with 280E and basically normalized the marijuana industry. So tax court has not been that good of a venue for this industry. You can also go to federal district court, and the disadvantage there is that you have to pay your taxes first. And some of these tax assessments are in the hundreds of thousands of dollars, so it's very difficult. However, we have a very good case where the taxes owed are substantially less, and my client, the taxpayer, has agreed to go to federal district court where you could actually get a jury trial. And hopefully you would have a jury of Coloradans where you would have a majority of that jury believing in this industry since the population are voted for it and not siding with the IRS. So the district court could be a better venue. It still wouldn't be a quick fix. Chances are the IRS would appeal it. You know, this issue is big enough that it could go to the Supreme Court. But it is a serious threat to the economics of this business. You can't attract investment. You can't work in a business where you're going to lose most, if not all, of your profits to taxation. So it's a serious issue that we all need to band together on and figure out a way to fix it. Unfortunately, I don't see any quick fixes. So that's mine.
Thanks, Jim. Just wanted to say that my mother was a CPA, and I made sure none of those genes passed on to me in the process. Our next speaker is regarded as one of the leading trial attorneys in the cannabis industry. He distinguished himself in the defense of the landmark case Champ versus Commissioner, recognizing the rights of dispensaries to deduct cost of goods sold and limiting the punitive applicability of IRC Section 280E to those expenses directly related to the trafficking of a controlled substance. Since Champ, Henry has been the lead attorney in the cannabis industry's most important cases, including the recent forfeiture actions against Harborside Health Center, Berkeley Patients Group, and Shambhala. A former federal prosecutor, Henry now leads his firm's offices in San Francisco and Seattle. Henry is a frequent speaker on actions against cannabis dispensaries and issues involving taxation of cannabis. He is also legal counsel for NCIA, so really important. And so please welcome Henry Wykowski.
Thank you. Okay. All right. So, 280E punitively disallows the ordinary and necessary business expenses of our industry. It's punitive because we're the only industry that has to operate under such restrictions. It's also punitive because it punishes the people who try to comply with the law. The only way that you can be audited is as if you file a tax return. The people that don't file don't get audited. This is one of the dumbest things that the Congress and the Internal Revenue Service could do, and it's up to us to do something about it. 280E was never intended to apply to people who are operating an industry that is legal in the state in which they're doing it. It was meant to apply to street-level drug dealers. And the only way that it came about to be applied to the cannabis industry was when the federal government was unsuccessful in closing down the cannabis dispensaries that started in California, the first state to have legal medical cannabis, and they couldn't put them out of business by prosecuting them because the juries wouldn't convict them. There was widespread support for them, and somebody got the bright idea that, well, the way we got Al Capone was through tax. Maybe we could tax them out of business. So they applied that, the 280E statute, to Champ. It was the biggest mistake they could have made because Champ was an ideal dispensary. They did everything right. And we went to tax court because the IRS would not settle that case, and we established some very important precedents that are important for the industry and that help us all. We established firmly and for once and for all that you can absolutely deduct your cost of goods sold. That's the biggest expense of any industry. Secondly, with respect to the ability to deduct ordinary and necessary business expenses, we established that there should be an allocation. If you're doing anything in your business other than simply selling cannabis, then you're entitled to an allocation. And it's the art of getting that allocation that is so important to each of you that operate retail stores. To give you an idea of the effect of 280E, if you were in a business with gross sales of $100,000 and your cost of goods sold was $650,000, you would have a net income of $350,000. In every other business, you would then deduct your expenses, which I have picked here as $200,000, resulting in a net profit of $100,000. Excuse me, $150,000. However, and you would pay the tax on the $150,000. Assume it's 40%. That's what you would pay. However, under 280E, you would not be able to deduct those ordinary and necessary business expenses, resulting in a net profit of $350,000. You would have to pay the tax on that. It's punitive, it's unfair, and we need to do something about it. And what we can do about it is, as we grow in our strength, as more people become employed by us, as we generate more income, as we go about it and generate more goodwill. Those of you who heard Ian Sieb speak this morning, he talked about if you're involved in the industry, connect with the people in your community. Do something that matters to them. Generate support. We all have a duty to go out and fight for what we believe in. And when we win those people over, they can talk to their congresspeople, you can talk to your congresspeople, and this law can be changed, and it's up to us to change it. If Obama isn't going to do it, we're going to do it despite him. Okay. I think that, as Jim said, I think that if you're in this business, you have to assume that you're going to be audited. And what I'd like to do is spend a couple minutes talking about what you can do to protect yourself, because you need to do that, because the IRS is not showing any sympathy to this industry. If you're an existing business, what you want to do is you want to have a knowledgeable professional review your accounting to ensure, one, you are taking full advantage of the classification of goods sold, and two, that you develop a formula that allocates your expenses between trafficking and non-trafficking. Because one of the things that I've learned in litigating with the IRS is that if you go in with a reasonable formula that you have used to prepare your tax returns, it's very difficult for them to challenge it. If you don't have a formula, it's a no-brainer, because they can say, well, you didn't take any deduction for 280E. 280E is important in this industry. You're going to have to now, we are now going to disallow ordinary and necessary business expenses, your expenses. However, if you do an allocation, and by the way, the allocation that we were able to get in CHAMP was 85-15. By that, 85% of their expenses were deductible, 15% were disallowed. If you go in with a formula, it's difficult for them to challenge the formula because there really are no standards for this industry. So I think you're much better off if you do that. What that formula should be is kind of complicated. It varies from business to business. But we've been able to settle cases with IRS on an 80-20 split on a fairly regular basis. Now, if you were starting up, what you want to do is you want to retain experienced assistants in setting up your accounting system. You want to make sure that you take full advantage of moving as many of your expenses as you can into cost of goods sold, and you develop the 280E formula that I just mentioned. And you want to establish yourself in a way to defend your position in an audit, because the IRS will not, of course, risk challenging that like they did in Champ. They learned their lesson. The reason that I say that if you're in this business, you should expect to be audited is that we've represented over 100 different businesses now that have been audited. We presently in my office have 40 cases that are either under audit, in IRS appeals, or have pending petitions in tax court. This is one of the most highly litigated areas in the tax court right now, and there is much we can do if we do it right. The risk here is that somebody who doesn't know what they're doing is going to try to take one of these cases to court, and they're going to get a bad decision, and it's going to reflect unfavorably on all of us. So if you're an accountant or a lawyer that is faced with that situation, I ask you to please reach out to the NCIA, reach out to any of us to talk about your case and to assist you, because we're willing to do that, because we've established some good principles here, and we want to keep those in place until the law changes, because if a bad decision comes down, they're going to use it against each and every one of us, and that's something we all have a duty to try to prevent. Now, if you receive an audit letter, how am I doing on time? If you receive an audit letter, get experienced help immediately. This is not something you should treat lightly. You're going to have a lot of money at stake, and the help that you get is going to make all of the difference in the outcome that you receive. Now, there's a dispute here as to whether or not you should have an accountant or an attorney represent you in an audit. I have to tell you, and of course it probably will seem biased, but I think you need to have an attorney. The reason I think you need to have an attorney is because there is an attorney-client privilege. There's no accountant-client privilege. And you can go over with that attorney everything about your business and never have to worry that that attorney is going to get subpoenaed to ever have to disclose what you told. If you just have your accountant do that, you don't have that same protection. And most accountants believe that they can do audits because for every other industry that doesn't face the challenges that we face, which are related to legal under state law, but illegal under federal law, they can do the audit. They only bring the lawyers in if there's a deficiency notice issued and then you have to go to tax court. So for routine audits, I think accountants are fine. However, for cannabis audits, I think that you need to get an attorney. The next thing is, the way the audits start is that you get a letter in the mail from the IRS. And there's a number of different letters they use. There's forms, but there's a few variations of them. And they say, hey, you've been selected for an audit. Please give us a call to set up a time and date for that. Or sometimes they even call you on the phone and say, hey, I'm a revenue agent. You've been selected for an audit. When can I come down and meet with you? Absolutely do not respond to that inquiry by yourself. It's one of the biggest mistakes you could make. These people are well trained. They'll get you talking. They'll ask you what kind of records you keep. They'll ask you a few other seemingly innocent questions, and they'll get all the information they need to get what they want from you, and you won't have any of the protections that having a representative would have. It pays to be well represented because that's where you'll save the money. Also, a disturbing trend that I've noticed with respect to the cannabis industry is the potential for a criminal investigation. Up until about 3 years ago or so, the IRS had a policy where they would either investigate a tax case civilly or criminally, but not both. So you knew right at the outset whether you were being looked at criminally or civilly. However, they've done away with that policy. They now have a policy that permits dual investigations, which means that they can conduct both a civil and a criminal investigation simultaneously without disclosing that to you unless you ask some very specific questions. And you should ask those questions, and you should make sure that you confirm what they tell you in writing. Because if it turns out to be a criminal investigation, you could go to jail. If it's civil, it's just going to cost you a couple bucks. There's a big difference. And we've seen now in a few cannabis cases where they have used a civil investigation as a cover for a criminal investigation. The agent comes in, asks some questions, and then they send out a letter that starts to ask all sorts of questions that, as somebody who used to work for the federal government as a criminal tax prosecutor, I recognize immediately as criminal tax questions. I've seen them ask, who's your accountant? Who else in your industry does your accountant do taxes for? What do you think they're looking for there? I mean, I said to him, what's this got to do with whether or not this guy's tax return is accurate? I mean, who is the accountant prepares taxes has nothing to do with any of the figures you're supposed to be looking at. You're supposed to be looking at substantiation of what's on the return and whether or not those deductions are proper, not who his accountant does. Where do your kids go to school? Is it a private school? What's the tuition? It's got nothing to do with the business. Those were surreptitious criminal investigations that fortunately we were able to stop before they became full criminal investigations. We've seen that now in 3 instances, and I believe that it's going on in more, but I can't say that for certain, but I'm sure that this trend is likely to continue. So you want to be very careful about that. Now, what's the IRS going to look for in audit? They're going to look at substantiation of the figures on the return. They're going to look to see what your gross sales are. They're going to look to see what your cost of goods sold is. They're going to look at your expenses, and they're going to look at your 280E allocation. How are we doing? Still good? Okay. So I think, you know, it used to be years ago when we were a nascent industry that some lawyers used to tell their clients not to keep records. You know, if you don't keep records now, you're in big trouble, okay? So you do have to keep them. But you can keep them in a way that doesn't jeopardize you or your clientele. In states where you're just operating medical dispensaries, your clients have every protection that is offered any medical patient under HIPAA. The IRS is not entitled to see who those people are. If you're in a rec state, I don't think you have to keep track of who those people are. All you have to do is verify that they're over 21 when they come in to purchase. But the IRS will want to see substantiation of your sales, how much you pay for your product, and of course your expenses, which you should track, and the 280E allocation. What's particularly ironic about this is by not allowing us to use banking like everybody else, they force us to deal in cash. And then they wonder, well, where are the checks? Duh. Where can we go to deposit the cash so we could write the checks? I mean, the federal government is really dumb about this. When I worked at the Department of Justice, the focus was to try to bring the underground economy above ground by putting the cash in the banks where you can leave a paper trail that is traced. But to not allow the cannabis industry to use banking like everybody else, they can't. They disallow us from keeping the kinds of records that the IRS would like to see, and then complain when they can't. But you know what? There's nothing illegal about dealing in cash. It's the legal tender of the United States. And you don't have to be embarrassed when these agents say, well, what do you mean you don't have any checks? You just say, look, these were cash receipts, you keep a record of them, and you say, this is what I have. They have to accept that. I hope that none of you get audited. I think you probably will, but I think that, or I hope that you've gotten something from this that helps you. If nothing else, stay calm, stay cool. You don't have to do anything right away. They're not the boss. You're in charge. You do what's best for you and what's best for the industry. Thank you. Oh, wait a minute. I forgot to plug myself here. Hold on. There you go.
Thanks, Henry. He brings up a good point. I think it was Abraham Lincoln who said, "He who represents himself has a fool for a client." And this is don't be a fool. This is really important. This is your livelihood, and you need to really think about this. Call these people. Call the three of these. Call any of these guys. Reach out to NCIA, and have the professionals help you. So our next speaker. Let's see. Our final speaker is owner of Luigi CPA, an accounting firm providing tax and consulting services to the marijuana industry. Luigi specializes in performing IRC Section 280E allocations, having performed over 50 such allocations. Luigi's clients span 6 states and include companies operating in a variety of related industries, including cultivation, retail dispensing, laboratory testing, concentrate and edible manufacturing, and LED indoor grow lighting. He is a member of BOTEC, a consulting firm providing advisory services to Washington State and other governments related to regulation of the marijuana industry. Formerly, he was CFO for Harborside Health Center in Oakland, California, one of the largest marijuana retailers in the U.S. While at the position, he was involved heavily in IRC Section 280E, including lobbying efforts and drafting proposed legislation to change the law, and educational efforts to inform others in the industry. In addition, he was director of PricewaterhouseCoopers, the world's largest professional services accounting firm. During his 12 years of experience with the Big Four, he worked with a variety of not-for-profits and other large companies to address their most complex tax law issues. Please welcome Luigi Zamarra.
Hello. So I like to say that there's 3 ways to address 280E. You can structure around it as best you can. You can do a lot of accounting work, or you can do both of the above. I recommend both of the above, but I'm here to talk about mostly the accounting aspect. That's what I'm here to talk about today. So some of the latest thinking right now surrounding 280E is to try to put as many costs as possible into cost of goods sold. As both Jim, Marty, and Henry have pointed out, the federal government has accepted that cost of goods sold is not subject to 280E. And this is based upon the 16th Amendment, which gave Congress the power to tax income. And income is defined as gross revenue less cost of goods sold. So it's a simple mathematical analysis. Normally, when you're working with most businesses, the tendency is, I want to claim a deduction. I want the expense now. I don't want to capitalize it onto my balance sheet. Well, this is the reverse thinking here. Because if you can capitalize it as an inventory cost, you're going to have to wait a little bit to take that deduction, but at least you'll get it. And you're much better off waiting for the deduction than getting no deduction at all. Now, there's a bit of an issue here because inventory layers can be semi-permanent. So it's not, even though your inventory is turning 9 to 11 times per year on average, you're not going to claim that deduction in the following year because there's going to be another added layer if you're growing your business and your inventory levels are increasing. So the good news is that both sections 471 and 263A allow for great leeway in you deciding what you're going to treat as part of cost of goods sold. A lot of leeway. The rules are that there could be no distortion of income, and whatever method you use to calculate your beginning inventory has to be the exact same method you use to calculate your ending inventory. Now, if you're a new business, this is easy. Bring in your accountant early. Bring him in early and help him work with the accountant and help him set up your business processes with 280E in mind. It will go a long way. Because in your first tax returns, you get to choose what you're going to treat as part of inventory and what you're not going to treat as part of inventory. You, as the business owner, have a lot of leeway in making those selections in your first year. Now, what do you do if you're an existing business? Well, if you've filed at least 2 tax returns using a particular method for calculating inventory, you have established what is known as a method of accounting. And even if that method of accounting is incorrect, you have to apply for permission from the Commissioner of the Internal Revenue to change that method. And the way you apply for that is by filing a Form 3115. It's a very complicated form. It is very difficult and very time-consuming to complete. You're going to have to fill one out eventually if you're under 471 and you're transferring or about to hit the gross income limitation, which forces you into 263A. You still have to file a Form 3115. So you might as well get going on it early. Now, as you're thinking about making all these elections in this method of accounting, one of the other things you should keep in mind is that both sections 471 and 263A do work in tandem with the election of lower of cost or market. Now, a discussion of lower of cost or market is beyond the presentation here, but I wanted to make you all aware of that option as well for you to choose. So, the name of the game is going to be to try and maximize the costs that you're putting into your inventory. So, any cost that is remotely related to producing, procuring, or storing safely inventory can be treated as an inventory cost. Now, I want to present 2 examples of things that I often see below the line that I think this industry should really consider moving above the line. One is security costs. With all the cash we're handling, our security costs are higher than your average industries. And I often see that cost listed below the line. However, if you think about it, you're incurring those costs to keep your inventory safe. That has to do with the storage and safety of inventory. So legitimately, you could argue that security costs should be treated as an inventoriable cost. Another example I like to use is a point of sale system. And at first you might see the word sale in there and say, well, Luigi, isn't that a selling cost? Non-deductible in 280E? Well, if you think about what your point of sale system does, it actually records 2 transactions every time you hit the barcode. It records gross revenue, which is selling, but it also records cost of goods sold, which is inventory. So most point of sale systems are an inventory tracking system also. So certainly at least half, if not entirely, you could treat your point of sale system as an inventoriable cost. Now, as you can see, there's a lot of work for the accountants to wade through all these costs and figure out what's related to inventory, what's clearly selling, and what's everything else. Now, I want to go back here. So let's talk about some of the limitations and burdens of this approach. First of all, the limitations. As I said before, any cost that is clearly marketing, advertising, or selling really should not be included or treated as an inventoriable cost. That's really your limitation. The more difficult thing is your burden. Certainly under Section 471, they point out that how you treat expenses on your internal profit and loss reports have a bearing. Now, what's not clear is to what extent you can have a traditional profit and loss statement where most of your costs are below the line, and when the accountant comes in to prepare the tax return, he does calculations to move things around and move them above the line. We don't know how far you can push that envelope. But what we do know is the sooner you can record that split, the better off you will be. So let's talk about this accounting burden. So you're going to sit there and record every transaction, every bill you get, and you get a lot of bills every month, and you're going to put them into the three categories: clearly cost of goods sold, clearly selling, and everything else. Well, it's easy with occupancy costs. You do your square footage analysis, you do it one time, you do it well, you tape those percentages up on your computer, and every time you get the rent invoice, every time you get the utility invoice, every time you get a repair invoice, you've got your split allocation right there. Pretty easy to do, Johnny on the spot, for every transaction as you enter it. What's harder is for payroll, because with payroll, particularly with smaller businesses, people are doing different things, and what they do from one pay period may be different from what they do the following pay period. So what I've been doing is helping my clients to develop systems to capture that information in real time. Having the employees fill out a timesheet to allocate their time between the three categories is really then a way for them to upload that into a spreadsheet that you as the business owner can easily sort of decipher and apply that week's payroll cost based on those percentage allocations. A lot more work than doing it for occupancy. And the third part that's really hard is the following year when you have to calculate your ending inventory year-end true-up adjustment. I'm just going to say it's really complicated. So just to summarize what the opportunity is to try to maximize the treatment of expenses as part of cost of goods sold, make the proper first-year elections, and if you're too late for that, file a Form 3115. Treat as many costs as inventory as you can except for advertising, marketing, and selling, and try and record those as soon, that split, if you will, as soon as you can in your inventory systems, preferably when you enter each bill, if possible, balancing the burdens and the benefits of it all. Now, what I'd like to, well, I've got a couple of visual examples that may help you to see the benefit of what I'm suggesting. And I've got a before under the old thinking, what a profit and loss statement looks like, and then under the new thinking, and I take that same profit and loss statement and I put it on page 1 of a Form 1120, which is the corporate income tax return. And if anyone wants to contact me, there's my contact info. Ben is, nope. Hey, Ben? I don't know if you have my before and afters. Give him a second here. While he's fixing that, I just want to point out that, you know, if you don't show any expenses below the line, there's a lot less for them to come in and argue over. Okay, so we have the, so here's the before. So here is a typical profit and loss statement for Luigi's medicinal products, that the way you might be used to seeing it. Okay, with the top line revenue, you've got your direct cost of goods sold and your packaging, and then all those other expenses are listed down below. That is the way most of us as business owners are used to seeing a profit and loss statement. But perhaps with a more polished approach to inventory accounting, it could potentially look like this, where a lot of those costs are being shown up in cost of goods sold. And here, the gross profit has come down from 10 million to 2 million. And what we're showing below the line are the costs for marketing, advertising, and selling. Now, these two profit and loss statements translate into tax returns that look like this. So this is page 1 of the 2013 Form 1120, and this is the before. So this is where we're showing most of the expenses on lines, 13 through 27. And look at all the bucks there on 13 through 27. Well, that's what the IRS agent, when they come to audit, is going to be most interested in. And wouldn't it be better if, when they came to audit, you could hand them a tax return that looked like this? How cool would that be? And you go, yeah, come on and audit. Ready to disallow all my below-the-line expenses. Don't have too many there. But that would be pretty powerful if you can present a tax return that looks like that. And hopefully that'll make them quit auditing you and go away. Anyway, I hope that's been helpful for everyone. Thank you very much.
And there are questions out there, so if you have them, please raise your hand and someone's going around to pick them up. And I don't claim to be a tax expert, so I don't have any questions, but I wanted to give you a little background of sort of what's going on in DC. I'm a policy person out in DC, a political person, and basically there is, like Henry mentioned, there is legislation out there to address it. Congressman Earl Blumenauer from Oregon has introduced legislation, HR 2240, the Small Business Tax Equity Act. It currently has 15 co-sponsors and is sitting in the Ways and Means Committee. The problem is it's a Democratic bill in a Republican House, and the chairman of the committee is not a fan. And so, not to get bogged down on tax issues, but Congress, every year Congress addresses, thank you, Congress addresses expiring tax breaks. And they usually do it, they put it all together usually in one legislative package called the tax extenders, and they usually pass it in the middle of the night when no one's watching, and they get it and leave town the next day to run out of town. And so what I hope to do in DC is to have the 280E provision inserted into a bigger tax extenders or a tax reform program that may happen. The problem is, because the chairman's not a fan, we need to get Republican support of the legislation. And the Ways and Means Committee is made up of members who are in Texas, Louisiana, Arkansas, Pennsylvania, Indiana, Tennessee, Kansas, states that aren't marijuana friendly. And so it's really sort of a non-starter right now, and it's hard to get traction. In 2015, it looks like the next chairman of the Ways and Means will be Paul Ryan. You've all heard of him. Maybe, hopefully, he'll be more responsive to the issue, but only time will tell. But that's something I'm working on behind the scenes and what I'm doing. Here's a shameless plug that I have to push. Before I joined NCIA about 8 months ago, I spent about 15 years on Capitol Hill working for Republicans. And I understand Republicans, I understand a politician, and what I'm trying to do is work on that side to get them to be supportive. Democrats understand it, but probably for the next 2 years at least, the House will be Republican, and we need to get some of those guys to come around to it. Last month, if you followed, for the first time in history, the Chamber of Congress, the House of Representatives, passed pro-marijuana legislation, and they had 49 members of the Republican Party support that. And if you think that just happened by chance, you don't understand politics. And it's something I've been trying to do, work behind the scenes, but I'm a one-person operation. And like Henry mentioned, but in DC, money and power is important. And what we need is to show a positive face for you guys to be politically active, you guys to call your members of Congress, call your senators, start attending fundraisers, start doing town hall meetings, and to be a good public face for this so DC can actually see it, and it's really important. And so let me ask some of these questions. Can state excise taxes assessed on gross sales be included in COGS?
Yes, it would be a cost of goods sold. Our new excise tax is the excise tax when the pounds move from the grow facility to the retail, and clearly a cost of goods sold. Also, a quick side note is that Colorado has fixed 280E. There is no more 280E problem in Colorado beginning the 1st of 2014.
What?
Yeah, it was fixed last year in our legislature.
280E?
At the state level.
At the state.
Oh, at the state level?
State tax.
Sure.
Yeah, that was a separate bill last year.
The one point I just want to perhaps clarify related to the question at hand is it really kind of depends on state law. So there's actually a tax advice memorandum out there that says that if the excise tax is applied upon a sale, that could not be inventoriable. But if the excise tax is applied at production, it can be. And there's a famous situation having to do with distilled spirits, where in one state, the excise tax gets applied when the distillation occurs, and in another state, it applies when the sale is made. And in one case, it's inventoriable, and in another case, it's not.
What about hiring a staffing company so there are no retail jobs?
That hasn't stood up in any audit. There was this strategy that was used in California many years ago that some people came up with. It's come up in a number of audits that I've been involved in, and the IRS sees right through that. They disallow it, and they also audit the management company.
Yes.
Can cash be treated as inventory?
Well, for what kind of business?
That's a bit of a layman's question.
For those of you who have to deal with cash in this business, it can be a real pain in the butt to deal with cash. You have to store it, you have to safeguard it. Not having banking is the other big issue. I think the two biggest issues in this industry are the banking issue and 280E, and hopefully they'll both get fixed soon.
The one way I would treat cash as inventory is to take a physical count regularly.
Filing date. Does an extension reduce the chance of an audit or anything else for that matter?
No, I don't think it affects.
Like I said, for as targeted as it's been here in Colorado, there's got to be a program at the IRS to go through the licensees. Pretty much a week doesn't go by that I don't get a phone call from a dispensary who wants to hire me to help them with their audit.
Explain how retail is different from cultivation on tax treatment.
Well, the good news about cultivation is almost all of your costs are cost of goods sold. There's not a lot of selling when you're only making a handful of sales. You have regular customers, you might have a delivery cost, you might have some time to interface with that customer. So your selling costs are rather minimum, And most of your costs that you're incurring are really part of cost of goods sold. The problem is with retail, what you're doing is bringing things to market. You are selling, you're engaged in sales. That's what retail is. So it's really kind of a world of difference between what a retailer is seeing for 280E exposure and what a cultivator is seeing.
For what it's worth, my tax practice is nationwide, and we're not aware of any cultivators being audited anywhere.
And the comment I would make for those of you who are into the what we call MIPS here in Colorado for marijuana-infused products, almost all of your costs too are deductible because you're manufacturing the edibles, sodas, the various products you see out there. The infused products people do not have a 280E issue either for the most part.
Hey, actually, I would like to say something about the comment I just made about the cultivators. Although no cultivators have yet to be audited, don't think that it's not going to happen. The IRS is looking at this industry as we grow, and it's going to start, just hasn't happened yet.
What is the best way to handle federal tax deposits and payroll tax deposits?
Well, the best way is through the bank. I mean, you can't, though.
You actually can pay those here at 19th and Broadway at the IRS audit in cash, but they will charge you a 10% penalty for not using an electronic system. And there is, as ridiculous as that sounds, they're penalizing you for something you can't do. There is a case heading to appeals to try to get those clients, those penalties waived. But for the most part, people do keep a small checking account that they can use to make payments that can only be made in cash. And ironically, those payments tend to be the tax payments. We're talking sort of bleeding over into the tax issue. A really good way to lose your banking is to be making regular, large cash deposits of money that smells like marijuana. That's a great way to lose your banking. Yeah.
This one's directed for Henry. Does IRS recognize and have to abide by the 14th Amendment due process clause if pursuing a criminal case?
Well, sure. Absolutely. They're not exempt.
And I would have a comment on that
Oh, sure.
too, is one of our cases that we want to take to federal district, specifically that issue. It appears to us that 280E was meant to be applied to people who have already been at least charged and possibly convicted of a crime. You know, the IRS has not really had to make a case because the tax return is clearly marijuana related. But we are going to appeals on that very issue, that the IRS has not made the case, that they haven't proven that, a dispensary in Colorado is trafficking.
You know, I don't know about that, because if you look at the language, we argued in the Champ case to the trial court judge, who was a conservative judge, but he was very fair. And at the beginning of the trial, I said to him, I said, you know, this doesn't apply. And he said, why not? And I said, well, trafficking connotes illegal activity. And this isn't illegal because they're licensed by the state of California. And he said, you know, let's recess. I want to research that. Come back tomorrow morning. He came back the next day and he said, you know, it's a great argument, but he says, if you look at the definition of trafficking, it's broad enough to include legal activity. So I have to find that it applies to this dispensary. So, you know, I guess, you know, a different judge could find otherwise. We did, after the Champ case, we considered appealing the case based on whether or not 280E should apply to dispensaries. But we felt that the decision was so good in Champ that we didn't want to jeopardize losing it. And what's really significant is that if we would have appealed, it also would have given the IRS the ability to challenge that decision, and they chose not to appeal. So, you know, another judge could find differently, and then we would be in the Court of Appeal and off to the races.
I just want to add one more comment. You bring up a good point about the definition of trafficking. And if you just look it up in the Merriam-Webster's dictionary, it actually says to buy and sell.
Yeah, that's what he looked at.
Just pointing that out.
It's pretty, yeah.
It could be broad, but it could be narrow.
It was a poor choice of words for Congress when they passed that law.
If you are running an ancillary business where cannabis is processed, trimming, extraction, etc., and the material is never taken into possession, would this be considered trafficking?
How could you trim if the material wasn't taken into possession?
You can. You could provide a service where you don't take title to the inventory.
It says an example,
You can
my dry
provide a
cleaner
trimming
never
service.
owns my suits.
Oh, I
So
In my humble opinion, and this is just my opinion, I don't think so. I really don't think they would have much of a leg to stand on. But I haven't done battle on that battlefield yet.
Is there any aspect of retail operations, i.e. advertising, storefront, improvements, etc., that can be deducted business expenses under 280E? If not, how do you stay in business?
Well, you can deduct some of your expenses. For instance, if you're selling T-shirts, or you're selling pipes, or you're selling rolling papers. None of those are controlled substances. So that's where both of my colleagues spoke about doing a 280E formula where you look at the retail space. How big is your dispensary counter where you actually sell the cannabis versus how much floor space you have where you're conducting other activity. And the other activity under CHAMP in all the cases is deductible. Whereas where your counter is located is not.
The more physically separated, the better. So if you are doing other business within that same retail space, a physical separation is better than not having a physical separation. Even we've thought about going to the extent of having a separate company within the same retail space to handle all the non-marijuana transactions, your pipes, T-shirts, and things like that.
I can't make out the first part of this question, but is the IRS in fact going along with allocation, or are they resisting it?
Oh, well, you know what? It's like everything else. It all depends on who the agent doing the audit is, who their manager is. I would say that most of them recognize some type of allocation, although I'm beginning to suspect that there's been a memo put out by the service in DC that says just disallow all of the expenses and not allow for any allocation. One of the trends that we've seen in the cases is that we're not getting very far with the revenue agents, but we're settling more cases in IRS appeals. For those of you who are not familiar with the system, after you complete the audit, you can either accept the results or you can challenge them. And if you challenge them, you go to IRS appeals. The name is somewhat misleading because they're sort of a separate but quasi-independent branch of the service. And these people have a lot of authority to evaluate the case based on the likelihood of what will happen at trial and settle it. So it's sort of like going to mediation almost. We've settled, I would say, 90% of the cases in appeals, and the ones we can't settle, we go to court. And you know, one of the things that we've been careful to do is always be willing to go to court, because when they see that you're willing to go to court, then they want to cut a deal, because what they don't want to happen is have another CHAMP case.
Yes, I'm definitely seeing resistance for any below-the-line items, and you know, we're just to the point now where our cases are getting to appeals, and you know, we haven't had a lot of really good luck here, with the two cases that have made it, or I guess there's 3 cases that have made it to appeals. So so we are also talking about litigation, and which is very expensive for a small business. Some of our clients who we're representing before the IRS have had to close up shop. So we're representing failed businesses and trying to get rid of some pretty onerous tax assessments. So this is a very real issue. Like I said, I see it as a very huge black cloud hanging over this industry.
Just the last question. Are there any more questions? Please bring them up. And where can people get copies of your slides? Are they going to be, how public are they going to be?
I thought they were available through NCIA.
Yes, we'll work on that.
If you want to send us an email, I can
Be happy
email
to,
you a copy.
anybody who sends me an email, be happy to send it back with the slides attached.
And if there's no more questions, I want to thank the panelists and just remind everyone, if you're not members of NCIA, please join. We're doing a lot of great things. I'm doing a lot of work in DC. It's going to take some time, but it's important that you guys get involved. And so with that, please enjoy the rest of the conference, and I thank the panelists.